you, Mehant. So just bear with me. You may get some little bit of background noise here. So just bear with me on that. And of course, if there are any questions, please shoot that forward. So what we will do today is, right. Yeah, let's understand the topic first on life of an investment banker. So I just first, will probably start with a question. I don't know how many of you are able to answer it, but let's still take the question. The question really is, what do you all understand by what is an investment banker? If you can send in some quick responses, that will be good. So it gives me a perspective to carry on, the session. I really want to hear from you. What is your understanding of an investment banker? Fund investor. Okay. What else? M&A work. Yeah, I expected this answer. Person, deal maker, deal breaker, advisory, bridging gap between investors, one who's good in valuation, who will manage a portfolio. Okay. So I got a wide range of answers. So yeah, that sounds that sounds like a merchant banking is a good answer. Portfolio manager, yes, good answer. Financing and investment decisions, Devansh, that's a really good answer. So what I wanted to tell you here was, like, you guys have put in a lot of answers, right? Custodian banking, yeah, this I'll explain a little bit later through the session. But let me just give you a perspective. What we're going to do in today's session, right? Okay, Lena says there is someone who assists his clients in raising debt and equity. Yes, that's a fair point. But let me just tell you this is how we're going to deal with this session. I'm not really going to have trying to explain what an investment banker really does or anything like that, but I'll give you a perspective that is slightly more broader in terms of what happens in the investment banking world, right? And that really will give you a perspective. So it's not going to be very narrow, just mergers and acquisitions, for instance, or just merchant banking, for instance, or just raising equity and debt. We will try and cover more broader aspects in terms of what it really means. So let's take an example, right? Let's assume you had $1 million in your pocket, right? What would you do, right? What are things you would do with $1 million? Tell me. Yeah, you're going to, so if you can just pop in some answers, that'll be really good, and we'll build up from there. Invest. Okay, someone says invest, diversify and invest. Everybody wants to invest. This population, we would make it 2 million. Ankit, that's very good. FD, real estate. Yeah, okay. So one risky and one non-risky. Again, invest. Okay. So seems like everyone's trending invest. Like what I would do if I get $1 million, I'll just retire. Isn't it the best thing to do? Why even bother investing? Because what happens to your investments in a time like COVID? Everything comes crashing down and everything will get wiped out. So why will I even bother investing? I will just take the million, keep it at home, and then enjoy the rest of my life, right? So that's what I would do. No, but okay, let's take this in perspective, right? So this is how one must be thinking, is what do you do with money, right? And this is how an investment banker is hired, basically to do two things, right? One is, and again, we'll expand the spectrum of activity of the banker. So one is, taking, the bank's own money and making an investment, or putting it to appropriate use. These are two terminologies I will use. And the second thing would be taking clients' money and channeling that appropriately. So you kind of think of two scenarios now, right? You have bank's own money that you're investing, or appropriately putting it in a channel, or you're taking clients' money and you're actually investing that or putting it to appropriate use. Now, what are expectations of clients and the bank, right? The expectation of a client is very simple. Let me start with the expectation of a bank. What is the expectation of the bank? The bank will say that please give me a return that is more than my cost of capital, because if I keep that money idle as capital, then that is my opportunity cost. And if you allow me to invest that money higher than the capital cost, then I will consider you as worthwhile. So essentially, the activity will be very much focused by the banker on making sure that he can generate a return that is more than the cost of his capital. So what do people do when they have to invest in their own money, right? So the banks usually have to invest in their own money. Now, usually what banks or investment bankers tend to do is, right, take up a lot of short-term investments and actually put them on. And the second would be make a selection of appropriate basket of real estate and long-term investments, to kind of mix up both very nicely to create a portfolio. Now, the other thing that they would end up doing, which you may not realize and may not be very apparent to you, is make sure that a certain amount of money is parked away as a liquidity buffer, right? That is extremely important. And of course, regulators also mandate it. So this is something that you will not realize upfront. I know everybody said, invest, 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 but to what extent would you invest, right? If I have $1 million, will I invest the entire $1 million? Now, that wouldn't be a strategy that a banker would adopt. A banker would say, yeah, I will take $1 million. I think one of them said, I'll try and make it 2 million. Of course, that's always the intent, but you have to be guarded and cautioned against something that is very important called risk, right? And the risk of investment and the calculation of risk around the investment is more important than being a banker itself. Now, when I say banker and banking activity, right, I will broaden this term. So hopefully you get the first part, right? Now, I will talk to you about what that banking activity entails. So you will get a perspective on what the banker does. So there are three or four aspects, and we will lead into the fifth one. So the key aspects of these are, let me just tell you this. One, making sure that you carry out a trading activity of multiple products. So the selection of products. So for example, I could make an investment in a government debt. I could make an investment in a real estate, but I could make an investment in a structured product. I could partially participate in an investment that is already made. You've heard of syndicates and syndication. It's a very important process that involves in the investment banking activity. And then one most important thing is, am I able to hedge myself and fund myself against the risks? That is also a very important part of the banking activity. Now, I took off an interesting point from one of the panelists, from one of the audience here, who actually said that I will try to make my money double. Now, there's a very interesting, aspect that one should take away from that. Can you tell me, if you were to make your money double, would the amount of risk be lower or higher that you will have to take to make your money double? Right? Higher. Radhika, that's very good. Yeah, I'm sure all of you will say high, right? And that's perfect, right? You absolutely have to take higher amount of risk. Devansh, that's a very good answer. What is the time horizon, right? So now, what banks will tell you is, yes, of course, make your money double. I mean, that will be the intent, triple, 5 times, who cares, right? As long as you multiply your money. But what you all got to be guarded against is, how do you risk manage it, right? How do you risk manage it? Now, if I take today's scenario, COVID scenario, for instance, is a great example for us, and thinking about investment banking activity in such a scenario, right? So now let's assume, that interest rates are dramatically being cut all around the world, right? What do you think the position, in say a bond, investment banker should hold? What sort of position should he hold? A long position or a short position? Just keep typing out. Short position. So I'm saying interest rates are falling. Yeah, okay. I'm getting long and short. Now look at the answers here, right? I'm getting long and short. So which means we've got a lot of confusion here. So our future investment bankers are still unsure about what it should be, right? Long or short. So for future investment bankers, let me tell you this. See, these are exactly very important decisions to be making, in times like this. So again, I get another Ashim says, I'll have a short position. So what happens when interest rates fall, right? The bond prices actually rise, isn't it? When the yields fall, the bond prices Soumya, that's absolutely correct. So if I hold a short position when the bond prices are rising, what am I doing to myself, right? I'm actually making a mess out of myself, right? So I'm going to be thinking about things like these to make sure and say, okay, if I think the bond prices are going to rise, I shouldn't be selling. I should be either holding the existing positions I have or buying into more, because my expectation is, as bond yields fall, my bond prices will rise. So I should take a decision. Now, I just want to give you this very simple example, and fortunately, I got both sides of the answers, which really helps me. Tell Shripal that we'll have to work on some of the fundamentals back in the classes. But the point really is, I was trying to make. This is just something that I wanted to share is that, these are very critical decisions an investment banker has to make well, well in advance, right? And that is how you've got to plan this depending on the anticipation of risk. Now, no one can anticipate a coronavirus and try to accommodate that, and someone has to be really god to be able to do something like this, or make an adjustment, or for positions that are there. But in day to day, what goes on behind the scenes for an investment banker is a lot of analysis of the market factors or market risk factors, or internal factors, internal decisions before a position is even taken. And even after a position has been taken on your books, they will constantly risk assess that position. And risk assessment is not only about accounting, right? To say, okay, how much loss we book today, how much loss we'll book tomorrow. But what is that this is likely to be? It's okay if we take a loss today, but I'm taking a decision to hold this on for 5 years. That is a very big part of an investment banking, decision making. Now let's take an example, right? Now let's assume, you sort of make an investment today in an airline industry, right? In the COVID situation. Yeah. So if you're making an investment in a COVID situation in an airline industry, what is your expectation? Your expectation is the airlines will fly one day, and they will take off one day. But you really got to have the courage to say today that, which airline should I invest, right? I don't know if Air India will ever fly again. I don't know if Indigo will ever fly again. I don't know if SpiceJet will fly again, or I don't know if Virgin Atlantic will fly again. I really don't know. So what is that I'm going to assess, right? So what is that I'm going to assess? So in this scenario, can somebody tell me, like, if I were to tell you, okay, I'll give you my own money. Let's assume, let's invest Shripal's money actually in this. Let's assume Shripal has $1 million, right? What sort of things would you consider? I mean, assuming you're all future bankers, what would you all consider, as some of the key parameters before you make the investment? Probability of income generation. That's a good one. Yeah. Return on investment, IRR. IRR is a very interesting one, Ashim. Viability, risk involved. Bobby Agarwal says assess the industry growth. Payback period, I think you mean not the playback period, but Ashim. Okay, fair enough. See, you've all got into a lot of aspects that are very much what you've studied, right? In terms of your books or in terms of your experience with working somewhere, debt, market share, all of these things. But see, the fundamental in assessing my investment is to go back and assess, okay, what is my objective of making this investment, right? My objective of making this investment is because I have exposure to 10 other industries except the airline industry. Hence, I want to make an investment in the airline industry. So first things first has to be, what is the objective of my investment? That is the key. Now let's assume you're all, yes, that's a good point, Ashim, diversification, right? See, these are things I will consider as well. Not only just look at the balance sheet and say this is good to invest. What if I already have airline exposure for 3 airlines and then I'm already discussing the fourth one? I mean, as a banker, you will come back and say, you know what, I don't want to consider this as, as an investment at all, because, I'm not even considering this, even though the financials may look good, because, my objective of investment now is to diversify away. I know one of the audience said that really well. Diversify away from my existing investments already. So you see, I already gave you a reason of, I look at a good balance sheet, but I don't want to invest, right? Because I've already got so much concentration in that industry that I don't want anything further. I just want to sit with an investment that is, different from this industry, or maybe something that is negatively correlated with this industry, right? It could be ITES, because, if you can't fly, what are you going to do? You're going to do something like this, right? We're all going to be on Blue Jeans and Zoom and all of these tools and apps, and they're going to make tons of money. So I would say I want exposure to ITES at this point of time, and I'll make that investment. So again, what I'm trying to bring out a point is, one of the key things in the life of an investment banker is not about just thinking about, okay, what is the money I'm going to make today, tomorrow? Yes, of course, that's always there. We've all got to make P&L. But yes, information technology enabled services. That's right, Ashim. So what is that we want to consider, and how do we want to structure our balance sheet? How do we want to make sure that the investments we make are strategic in nature? Let's assume I didn't even have any real estate exposure. This may be a great time for me to turn around and say, you know what, let me just pick up some real estate exposure, because no one else is buying real estate. Prices are low. I'll get great bargaining power. So let me get in. I have some surplus money. Maybe let's do that. Or maybe as a banker, I will turn around and say, no, I'm going to pause all activity on investment banking and I will come back. So, decisions. So just don't think about what you answered in the beginning, right? Is I'll make my money double. This is all my job. I'm like a cutthroat, money making machine as an investment banker. No, not at all. See, the key thing is risk management is the most important part of investment banking. Of course, if today you cannot risk manage, there is no point of making that investment at all. Now, I'll give you an example, right? How many of you have heard about the 2008 crisis, right? And what happened there? So I'll just give you a very simple example, and that'll give you, how the investment banking, shape of investment banking and the job that the investment banking banker did, completely changed. So yeah, real estate crash. Okay, we'll pick that Lehman Brothers bankruptcy. Yeah, bubble burst, CDOs, fantastic. Everyone talks about CDOs and all of that, but really what happened there, right, is what we've got to understand very clearly, right? Very, very clearly. See, what happened was back in 2006. So you shouldn't look at 2008. Actually, you should go back to 2006 and see what was happening there. All of the investment bankers were looking at the housing price index in the US, right? And back then, and they were seeing the housing price index were going only in one direction, that is north, right? Which means it's always heading up. And rising housing prices. Yes, somebody said that correctly. Now, once you see that kind of an index, now it's not about loan that were given to people, but it's about what built up in the investment banker's mind is what we are studying today, right? It's not about what exactly happened. So now everyone's looking at this housing index and saying, you know what, great, it's all going up. They're looking at unemployment rates extremely low. They're looking at inflation extremely modest. Good modest inflation is really good for economies. So they're looking at that. Currency very strong, stable. So everyone thinks United States is really doing absolutely amazingly well, only to realize that some of the banking decisions, and I'm here coming to risk management, are being taken in isolation. And what is the isolation here? No one is trying to understand the underlying risk of the portfolio that they are investing in. So they all bundle up multiple collaterals. So let me give you a very simple example of pooling of assets. That's all CDO is, without getting into too much technical jargon, right? Let's assume an investment bank gave out 50,000 housing loans. What they would do essentially is they will not account for it one by one. I mean, I'm not talking about the physical accounting, but I'm not saying they won't manage it one by one. What they do is they pool the assets, they create a pool value for that, and they issue units based on that pool value, right? And they have different tranches in that. Again, I won't technically complicate it, but you kind of structure it in that way, and you provide a value to that investment. Now, what is very important is it's not about doing this. This you and I, anybody can do. With a little bit of experience, we can do this. But the key around this is risk management of this. And that is the biggest part of the activity. So if you have still not understood the importance of risk management, I'll further stress on this through this example. So what began to happen was slowly each of these pools, right, looked very attractive because people said, oh, wow, this has got all the fantastic palatial houses in this pool in Long Island in New York. So this seems to be an excellent pool of assets to invest in. Okay, so I'm going to invest $1 million in this fund. Okay, go ahead, make the investment. No one ever realized that that $1 million house were actually bought by a customer who did not even have the ability to pay. And the smaller banks, which is Washington Mutual, and there were multiple smaller banks that actually said, okay, come with some documentation and I'll give you the loan, but I'll charge you higher rate of interest. They said, okay, fine, as long as I can live in a fancy house, I'm fine, right? I somehow I'll try and manage. And US is anyway a debt-ridden economy, right? So people are always under debt, so they'll say, okay, let's pay another EMI, not a problem. So they went off and bought off houses that were really, really expensive, but without the
assessing the underlying ability to repay those loans. Now, that became such a fundamental problem. And you now think of this, what did one need to do? If it were you and me, we would have said, let me first understand the risk of this portfolio. Now, this was the failure of the bankers because they were looking at only selling this junk portfolio to somebody and then extracting money out of them. So this is really the dark side of the banking, right? This is what happened. And then people started to say, oh my God, what's happening here? People are selling us stuff where the underlying credit rating of each of the customers in the pool is extremely weak. They're not repaying us back. So what do we do? Now, which clearly meant that people taking positions on their books for these portfolios never risk manage these positions. They simply said, yeah, it looks attractive, everything is moving up, the prices will go up further. Like we keep saying in India, right? Yeah, debt trap. So we keep saying in India, right? Okay, now the market is at 20,000. I'm sure it will go to 25,000. I'm sure it will go to 20,000. How sure are you? What assessment did you make? What are the risk factors you consider? Did you consider interest rates? Did you consider RBI's repo rates? Did you consider reverse repo rates? Did you consider liquidity in the market? Did you consider a political change? Did you consider a geopolitical risk? Did you consider all of these calculations and then decide the market is moving in this direction? No. You simply said based on some newspaper article, oh, looks like today the market will go up. So it's very sentiment based. Now, investment bankers are not sentiment based, and they became sentiment based at that point of time, and with a bad intention to make money quickly, to double their money, and that's what they started selling junk stuff in the market. Now, assume when you've sold so much of on different balance sheets, people receiving that as also not risk managed and never thought of risk managing and saying, I should not take this portfolio because it is inherently risky. So again, a failure of risk management is very evident. A failure of risk management is very evident in the process that you can actually see, within how the portfolios were being managed. So ultimately, what happened to that? The portfolios came down crashing, and what was all this attributed to? Greedy bankers and then failure of risk management. But because I have a really intelligent lot attending this class, I can tell you, you will quickly pick up this and you will say, actually, risk management was the fundamental to investment banking, right? So whenever you go out and think about investment banking, first think about risk management. That if you don't understand the risk of this, then that will be really good. Now, there's a question right now. Maybe I'll try and address it straight away. He says, "Is FRM, helpful?" See, FRM is fantastic. It's a great course. CFA is a great course. Please pick it up. Your CPA is a great course. So please pick it up, do it. No problem at all. But what you need is good experience to back it. Yeah, it needs. How does a CPA could play a role in media and investment banking? See, I mean, like I am a CPA. I got hired based on being a CPA in these investment banks, right? Um, and this is how it works. Now, FRM, for instance, is your ability to manage risk. CPA gives you that ability to manage risk because you're going to study a lot about, I don't know how many of you have done your FAR subject, but you'll see some fantastic, standards, right? FASBs and ASCs and, IFRS standards on derivatives and risk management. So they've considered all of these factors. There are very good examples in, if you go in and see what is a fair value hedge, what's a cash flow hedge, what's a speculative activity. So, you have all of that in there in your US GAAP standards, right? So these are things that will give you a very good idea and a foundation of how things can impact a balance sheet. Without understanding this fundamentally, right, you may do any other course, it will not help you so much. So this is how it will help you a lot. There's another question. So I'll pick up some of these questions as they come along. Valuation domain, very helpful in investment banking, very helpful, Sahu. I can definitely tell you it's extremely helpful. You know what we'll do? We'll park 5 minutes for career questions towards the end, if you guys don't mind. But please put your questions in, so we'll try and go through some of them. And that will help everybody so that we don't disturb the flow here. But thank you for your questions. These are really good questions. I don't mean to discount it. I just mean to say we'll collect it together because there's a lot around your career you're trying to discuss, and I'll definitely help you with this, having the benefit of doing my FRM as well, my CA and CPA as well. So I've got those credentials. I've done a little bit on IFRS as well. So I'll definitely help you with that. Now let's just switching back to risk management, right? And a lot of the questions were around risk management. So I'm really happy that you guys are following this.
Now, let's take a yes, sure. I'll answer that, Prince. You're an FRM student. I'll help you with that. Don't worry. Now, if you take a step forward, right? Let me ask you a quick question. Can you tell me the size of the top investment banking deals that have happened? Say mergers, top mergers that have happened or acquisitions. Anybody? The value. I need the value. Or and if you know the company name, I'm fine. Even if you know the company name, I'm fine. The two companies that were merging, or one was acquiring the other, whatever you know. Saudi Aramco, ING Vysya Kotak, JP Morgan with who? I mean, Capgemini acquired Alton, good examples. JP Morgan and Chase, very good one. Vodafone and Idea, good. Walmart and Flipkart, very much. How can we forget that? Allahabad and Indian Bank. So we've got a lot of India examples, not bad. Walmart and Flipkart is a good one. Yeah. See, now we've got all the small ticket items on this. Has anybody heard of, Time Warner? Time Warner. That used to produce a lot of. Yes, I saw that American Online. Can you please ping that again, please? AOL and Time Warner. Can you please ping that again? Somebody has just put that in. Can you? Yes, Bobby. That's the one. That's the one I'm talking about. Yeah, Bobby. That's right. Absolutely right. So that is 165 billion US dollars. 165 billion US dollars. So it would mean, you multiply that by 80, 165 billion, put the number of zeros against it, 7 or 8 zeros, and then multiply that by 75 or 76 today, will give you the number and the size of that merger. So do you understand the magnitude of that merger? Right? Yeah, it took place a long time back. Yes. And any other one, have you heard of Kraft Foods that went off to acquire like things like Cadbury's and all of that stuff? That was again, yes, Akash, yes. So multi-billion dollar, sort of Fox and Disney, yeah, of course. So these were all, top 5 in the steel industry, Madhur, that's right. Multi-billion dollar investments. Now, if you think about this, right? Now, again, let's go back to the agenda, right? What does it say? Life of a banker. Now, how do you think this merger came about? Is it like one fine morning we got up and said, hey, you know what? Let's take up Times Warner, go to their office and say, as an investment banker, no, let me go quickly and tell them that we can acquire this company. This is not buying vegetables, right? A lot of planning goes into this, and some of the merger acquisitions, you will not believe, are planned 10 years ago. And I can tell you this from my own personal experience of having been, and reviewed some of these deals, that it goes back 10 years in the planning. To say, if we want to make this merger happen, we will need to build these companies in this fashion, and then the synergy will exist to have the merger, right? And still, more than 80% of the mergers and acquisitions are failures in some sense. They never achieve their objective. But the idea really here is that, tremendous amount of planning goes in. So what is that planning that the bankers are doing? The bankers are watching what the price you can acquire from this merger. What is the capability that the acquiring company can get? What is sort of addition to the revenue, profit, top line, bottom line that is getting added? Does this mean it will create a situation where there is nobody else in the market and competition is wiped out? Of course, there are anti-competition rules that will play in, but does this largely make us the kingmaker in the market? That's what they look at. Can I extract more value for my shareholders? That's what they look at. Then can they look at, yes, synergy benefit? Absolutely, Sai Prasad. And can they actually look at, then saying that if we add on these two capabilities, then we probably can make, a new product out of this. So can we get into a new market, a new venture? So something like, what all of these investment banks do, right? They'll keep acquiring the small tech companies. And then what they do is they then say, okay, we created an algorithm to do trading. They didn't create it on their own. They actually acquired a company which was doing fantastic algorithms. They merged it with them, built up the capability, and now they're making millions out of what you would call, an algo. So there could be an example like that. I'm just making some examples here for you guys to understand, right? So that could happen. Now, how many of you heard of the merger, that happened with Nike and Reebok? Right? A simple example.
where your Adidas, some of those companies, right? Shoe companies. Now, what are they doing? Now they're creating a big brand for themselves. What is Kraft Food doing? Kraft Food is creating huge amount of brand value for all its products, right? Now with Time Warner, with Time and AOL, and combining media and everything is tremendously under the control, right? And they've created a huge conglomerate that is massive, $165 billion. Now, coming back to the life, right, of the investment banker. Now, what do they need to do? They need to price this properly. They need to have a proper purchase consideration. They will need to make sure the goodwill is okay that they're trying to get in. So all of these go in. And these are not only the job of the investment banker. They have a team along with them. You have a legal team, you have a compliance team, you have a accountant, you have an auditor, you have a consultant, you have big fours involved, and then you have the bankers themselves. This is the size of the team that actually goes into one of the mergers and acquisitions. And like I said, it's years of planning. So when you see suddenly a merger happening, don't think of it like it happened yesterday, 3 days back, Dhirubhai Ambani and maybe Facebook spoke and that it's done. No, it's been years. Now, if you take that example, right, a very simple example of what happened there. Now, what is the objective of the Ambanis here, right, or running their RIL? They're saying we want to be debt free, right? So now the investment banker has to watch out for this. So you got to be very clever in making sure and advising, because Mukesh Ambani on his own will not, just do things of, he will take advice. Though he's extremely, intelligent and smart, he will still seek external advice. Who will he rely on? So if you look at the client side, he will rely on an investment banker. He will approach the banker and say, you know what, my objective is to be debt free. You give me the options of how I can be debt free. If he came to me, I would say, repay your debt. You will be debt free. Very simple, right? But he will say, if it was that easy, I wouldn't have come to you. So give me an alternative, right? And then he will say, okay, what's the alternative available? Then as a banker, I should have ready solutions. Because if you sit in Mukesh Ambani's office and tell him, wait, let me think and come back to you in 10 days, he'll say, wait, I don't need such a consultant. I need someone who's ready, who's thought about my company, who's willing to kind of give my company a shape. And that would be a very smart investment banker who has said, Mr. Ambani, here I think is a deal which is really sweet for you. And then why don't you pick it up? These are the benefits. And they would have said, yeah, Facebook. So you see how internationally you got to be, connected. That Armco deal that people spoke about from the Saudi oil refinery, where Reliance gave away a portion of their stake to reduce the debt, 1 lakh crores almost, right? I mean, my numbers may be slightly, off, but you know what I'm saying. Such a massive deal. Did it take place overnight? No. British Petroleum, with Reliance Industries. Did that take place overnight? No, it was a $20 billion investment, right? Did that take place? No, not at all. So those are kind of, you've got to think about, okay, this is a giant. I need to take care of this giant. I have to feed him well. I have to keep him happy. So I've got to study him fully well in terms of understanding what his objectives are, find a matching partner, create a marriage, right? And a marriage that lasts successfully. So tomorrow if Facebook wants to expand its base in India, it has found a partner. It will use the Geo platform, and we know what's going to happen, right? They're going to do all sorts of things with that platform, and you're going to have, if you use Geo, you're definitely going to see Facebook on top of it, and all other add-on features that will come along with it from an India perspective. So there's going to be a massive expansion, and that's what it helps Reliance. So someone's really brokered a very nice deal between Facebook and Reliance to say, yeah, you guys can synergize very well because one needs and the other needs. Yeah. So the question is, objectives of clients are at the same time. I couldn't read it fully, but yeah, it just disappeared. But look, I mean, what I'm trying to say is, and probably I'll address that question in that way, is that the life of an investment banker is just not about making your money double. It is about creating synergies. It is about making sure that the right things are done to be able to sustain, a company. It's about sustainability of the clients, the shareholder value, and massively about risk management and reputation. Assume you risk manage these deals very poorly. What's going to happen to your reputation? No one's ever going to hire you as a banker. They're always going to say, oh, you go to these guys, they don't know how to price it. They don't know how to, they missed our objective. So this is where your smartness really comes in. And a lot of you raise the question on, if I get this education, will this happen? See, education is fundamental, right, to all of this. If you don't educate yourself, you will never be able to achieve these things. Now, People may turn around and say, but Warren Buffett didn't study as much as I'm studying. Well, look, I mean, there's only one Warren Buffett in the world, right? And if he thought about making some investment decisions, he learned through his experience. So you also have that opportunity to learn through your opportunities. Now, let me shift gears a little bit to say, how one would pick up a valuation, from an investment banking perspective, right? A lot of questions around valuation. So just think about this, right? If I were to ask you to create a value for a company, a book value for the company, what would you do? Quickly, all of you are accountants or becoming accountants. What would you do if I were to tell you calculate a book value of a company? Discounted cash flow. Okay, one method, fine. I missed. Sorry, I didn't get that. Discounted cash. Goodwill. Goodwill is an outcome. Current asset value. I like that. See financial statement. Only seeing won't help. You'll have to do some calculation. Value all the assets. Debts. Okay, so I'm getting really part answers here. See, what you would do basically is you have multiple methods. Anand, that is right. You have multiple methods of doing it. So you will pick up a method, asset minus liability, very simply put and very nicely put, Sandeep. You do asset minus liability, you arrive at equity, you divide by the number of shares, you will get the book value per share. In a net worth, yeah, Ashim, that's right. So you get a book value per share. Net asset divided by number of shares. Ritik, that's absolutely what I was saying. You're right. So you get a book value per share. Now, if all deals were to be done on valuation through the books, don't you think we all would have been investment bankers, right? We all would have become investment bankers. So see, look, a valuation for, a company starts with its book value, right? It starts with its book value. Then, yes, I can see, Ashim, you put an EPS, PB ratio, PE ratio, exactly. So it starts with your book value of assets, and then it builds on in terms of seeing, okay, what is the potential? So first thing I do, fantastic point, Aniket. This is exactly what I was going to mention in the next statement, right? Is that once you've created your book value, you've got to understand the forecasted value of your cash flows, right? And only intrinsic value won't help, Devansh. So you will have to forecast the value of your, cash flows for the future. Then you've got to take into consideration what are the constraints. You will have to take into consideration what are the regulations. I'll give you a very simple example. If somebody wants to expand and take a stake today in India, like HDFC took 1% from China into an investment, but what happened suddenly? The government changed its FDI policy. So now you go in as an investment banker, you can't just say, okay, I looked at the book value, I will price it 20% above the book value, and please subscribe to these shares. Exactly, Vasudha, market scenario. So that is only the first step to say what is the book value. Of course, if I get the value of my share lower than the book value, it's a shame on the investment banker, because he will say, you could not even get me the book value from the market. What sort of a banker are you? Or what sort of a company I am? I'm worthless that I can't even get book value for my company. So, it starts with book value, goes into projections, goes into market scenarios, goes into regulations, then also goes into what the other party is willing to pay through the brand of this particular company. So if you take for that today, for we consider value of compare. Yes, this is what I was exactly saying, the market scenario, right? If I want to, I don't know what to do. First, I'll create. How can we quantify the market scenarios? Yes, Madhu, that's a very good question. So I'll come to that in a bit. Right. So what do we do if you were to today say, okay, Chennai Super Kings, I want to create a valuation for. What will I do? I will first look at their assets. I will look at what is their worth. But then I will go into the market scenario and say, what is the ability for a cricket club to actually draw money? So that's a market scenario. You will go back into some analysis and say, historically, when clubs, and then you'll say, oh, they never existed any cricket clubs in India before this. Then you will actually go in and say, okay, in the world, if there were any cricket clubs, let's go to England, let's kind of analyze, let's study what actually happened and translate that into Indian scenario. Look, I cannot give you one single answer of how it is done, because you will have to make sure that you understand what you're valuing. I intentionally gave you a Chennai Super King example. Not that I'm a big fan, but I'm just saying that this is a very difficult one to actually value because you don't have a benchmark, you don't have market scenarios, you don't have anything in your hand. So what you'll rely on is to say, what is my promoter's ability to draw money? You get into qualitative aspects. And you'll say, okay, Srinivasan from Indian Cements have basically issued IPOs in the past. He's got great pull. He sits on the board of 25 companies. So I'm pretty sure if he goes in for an IPO, I'm going to get these investments. Why will they invest? Because Vasudha says, they're going to generate huge amount of cash flow, because whenever there is a Chennai and RCB game, or there's a Chennai or a Mumbai game, or a Chennai or whatever game, Hyderabad game, it's always going to be full. Tickets max out. The pavilions sell very well. So they kind of put in all these scenarios and say, this is probably the highest selling game when Chennai Super Kings play. So this is my expected cash flow. These are my expenses. I may have to increase salaries for Dhoni and company, but at the end of the day, this is what my net return is going to be. This is the scenario how they monetize it. And now what they will do is an overlay. They will say, given that I have the best of the stars actually applying and the demand for Chennai Super Kings is the highest, when I actually go into auction, speak to players, and you take kind of the past performance into consideration, and you see the track record, you say, okay, I will do a projection and some mathematical probability. See, look, a lot of mathematics is involved in this, and that's why a lot of valuations go wrong. If they make certain assumptions and say this is the direction it goes in, based off that, they discount the value back and say this is worth today, because I know 5 years down the line, Chennai Kings will be the most valuable team, because I know Dhoni is still 35, he'll play for another 5 years, and Dhoni probably attracts the best brand value on any advertisement that goes out. Today, people are offering him 5 crores for an ad, so which means if they are seeing him on television, I will maximum viewership. So if I am as Chennai Super Kings trying to put a brand logo on myself, I'm going to demand the highest amount of money. Therefore, my cash flows are going to be very high. So you understand just a simple mechanics of a very odd example. It's not a day-to-day example that I've taken of a FMCG company or a real estate company or a finance company, which is very easy to value. Something like Chennai Super Kings is very difficult and very abstract. Like, I'll be very scared putting my money into Chennai Super Kings. Who knows what? Tomorrow, if 3 players leave, if 5 players are injured, they break their leg, what am I supposed to do? Right? So all of these probabilities also come into that. They'll say, what if Dhoni is under the bus one day? What happens? Even that scenario is actually considered. Have you heard of actuarials? And all of you have heard of the concept of actuarial and actuarial valuations? Yes, yeah, I see a lot of yes. See what happens in an actuarial valuation. They actually calculate your actuarial death, right? So not your real death. They calculate your actuarial death, and they come back and say this person will die at this stage. Now let me calculate his pension obligations. In pensions, absolutely right. You guys are studying your CPA well, right? So they will actually calculate your actuarial death and bring it back and say, what? This should be the amount that you should be contributing to the pension fund. So which means, what have they projected? A scenario which probably only God knows, right? They have bought in and they have said, I can actually predict your death. Fantastic. Even my horoscope reader couldn't do that, but you've done it for me really well. So your actual death is there, you bought it back, and you've actually got people to contribute to a fund which they don't even know what it will be worth when they die or when they will die. So similarly, all of these probabilities and mathematical calculations actually come into valuations. That's why it becomes extremely complex. And why you got to be very careful is, when an investment banker actually looks at these valuations at the receiving end, should actually break down the assumptions. An assumption is extremely fundamental, right, in understanding anything. If I have assumed that Chennai Super Kings tickets will sell linearly as full house for the next 5 years, it's a bad assumption. I could have simply made a prediction and said that, I realized that every 10 years in Chennai, in March, or in an away location that Chennai plays, 3 games are always washed out because of rain, which means my revenue needs to be discounted by that. A very simple example, right? Somebody asked me about how do you factor in probabilities of a full house? Exactly. Or probabilities of the game not even happening. You've got to bake in all of this. And this is really the job of the banker, right? To make sure that he gets into these assumptions, breaks it down, analyzes it, risk manages it. I'll repeat, risk manages it fully and says, you know what, based on all these circumstances, I feel the value is very high because I don't think Dhoni will survive more than a year. I don't think this will happen more than a year. I think people will start losing interest in cricket because people are now finding badminton more interesting than cricket. Right? Bring in that probability. Yeah. So you get that aspect. So now I'll move away a little bit more and come back. Come back into the topic through that mechanism. Now tell me, a lot of people need financing. Have you heard of financing? All of you have heard of financing. How financing happens. Now a banker is actively involved with the financing activity as well. So let me give you an example, right? Suppose I want to, now this is where the debt structure comes in, right? Okay, so can somebody tell me what is an ideal debt equity ratio? Yes, Ashim. Can somebody tell me what's an ideal debt equity ratio? Oh my God, I expected this answer. Stop. 2:1, 2:1, 2:1. Now, can somebody tell me why 2:1? That's the key. Can somebody tell me? Bhaumik, I like your answer. Some of you, I really like your answer. Yeah, but can somebody tell me why 2:1? Akash, right answer. Can you tell me? A lot of you have said 2:1, but I now completely the chat stuff. Cost of debt is less. So why 2:1? Why not 3:1? Optimal leverage. Why? 3:1 can be a good leverage. Interest coverage issues. No, it doesn't work like that. Okay, now let me explain to you, right? See, 2:1 is somebody wrote it in a textbook, right? And said 2:1 is the ideal ratio. It was just to indicate that for every dollar of equity, I can have $2 of debt. It's only to explain that by doing that and increasing the ratio of debt, you can get certain benefits. But what if I tell you that some of the leading investment banks in the world have a debt equity ratio of 14:1. 14:1. Does that throw your 2:1 away? And would you go back and advise those banks to come back to 2:1? Never, right? It is really, yeah, Akash, that was a nice laugh. Will you go back and tell the bank, sorry, I read 2:1, that's the ideal debt equity ratio. Can you please change it back to 2:1? 14:1 is too high because my textbook never said have it 14:1. Yeah, this is where we've got to move away from our thinking, right? And say, okay, it is about very, very important aspect you've got to consider again is risk management here. For banks, it's their core business. That's why Ritik says, but look, I mean, your debt equity ratio did not put a star and asterisk marks and tell that for banks, it should not be 2:1. Right? So it never says that. The point really is there are a lot of industries which are operating at much different, like somebody said, Reliance was operating once at 4:1. Very good for them. It was at that point. See, it's a playoff, and this is where your thinking is very important and investment bankers thinking, right? If I'm able to borrow in the short-term market, right, depends on the risk appetite of the shareholders. Yes, I mean, that becomes too generic. Let's make it very specific, Aniket. See, let's take an example, right? If I'm able to get debt very quickly, I'm going to make an investment very quickly, and I know I'm going to get a very quick return. I rather borrow, right? I rather borrow. Say for instance, in the opportunity today, ownership is not divided. Very, very good point, and I'm going to touch on that very importantly. See, I'll give you a very clear example, right? In today's scenario, right? Assume you guys think the bonds are really, something that you want to buy, right? Today, I mean, let's make it up hypothetically. You really want to buy, or you want to buy a short-term debt instrument, or you want to really seize on a small opportunity and saying, you know what, I want to invest in this, but I really need it for short-term investment. So I really need quick cash. Now, will you go and issue a rights issue or an IPO to buy that? It's never going to happen, right? Or you're going to go back and say, oh, already I'm at 2:1 debt equity ratio, so sorry, I can't make that investment. That's an opportunity lost. What you will analyze is, you will say, hey, cost of borrowing in the short term, cost of borrowing, I'll come to that, Aniket. Cost of borrowing in the short term market is actually 4%, and the investment opportunity that I'm looking at is giving me 6.5%. So let me quickly go to the short-term market. I've got a really great reputation as an industry. So I'll go in for an unsecured loan. The interest rate may be slightly higher. He's going to say, yeah, cost benefit. So he's going to say, I will give it to you at 4.3 instead of 4 because it's unsecured, and you can take the money and return it to me in 6 months. So he'll be like, yes, give me the money now. He makes the investment. He quickly gets the return in 6 months and pays the money back. Now, for that duration, your debt equity is going to look very skewed. It's going to look like suddenly, what happened. I was 2:1, I became 4:1 with that much. But what you missed out is to see what a great opportunity I could cash in and actually make that. And that really is the intelligence of your banker to basically advise you on these opportunities. And look, we are not talking about small industries, right? Investment bankers don't approach tiny industries, right? They usually focus on the larger stuff, larger dollar values. And when I say large, not always in 500 million, but at least in some millions, right? They would not be doing a trade for 25 lakhs, right? Very rare. You will never be doing that because you can't even cover up the banker's salary, right? So this is yeah. Can we not include this in working capital loan? You can include this as current liability. You can, but still it's debt, right? You're still leveraging yourself a little bit. You could still have it for a longer period. I'm just trying to quote an example to say that I can still borrow without looking at my debt equity ratio. Of course, you can take it as working capital because it's short term, you can deal with. But let's assume you go into a little bit of 1 year debt, right, and make a slightly short. You will suddenly change the classification. I think accounting at this point, think about the principle that I'm trying to bring in, is to say I can still leverage myself a little bit more than my classic 2:1, which I don't know who wrote in which book, but I first need to see what is the opportunity in hand and what does that opportunity give me. Of course, it can go wrong. I may not get my return. That's fine. But you've taken a calculated decision based on what you think you can earn from that. And that is why you see a lot of companies leverage, because their access to credit is easy and their understanding of the opportunity to invest is always there. So they cash in really well on borrowed money. Now, I am not advising you to do this in the individual capacity. It will be a disaster because you need still a lot of experience to borrow and invest. Right? In today's market, people will borrow. Like you will see people leverage themselves. They'll say, okay, the Sensex was at 6,000, and people will say, wow, I know this is going to go up at 8,000 anytime. Let me borrow 25 lakhs and invest in the market. People do that. People leverage themselves and make an investment. But yes, if they're good, they're great investors, they understand the market, they know the play, they're experts, they can do that. If they're not, and they're ill-advised, then they will lose all their money, right? So this is really important. And now let me just kind of bring you a little bit to the dark side of things as well, right? So you get the concept of leverage, right? A little bit. So this is another aspect that banks focus on. Now, very important question that comes up is, so why are they called greedy bankers, and what makes them really, get a little bit of a bad name? Because, there's been a history with a lot of these banking, and again, anybody specifically, because everyone's very ethical and they issue really good conduct statements and everything. So things are going well, but you will always have somebody, who will spoil the name for largely what is really good. Some of the bankers, I'll give you one example. There was a classic merger and acquisition that was happening. And, someone tried, so there were two bankers involved, 2 or 3 bankers. I can't recall whether it was 3 or 2, but let me go with 2 for the moment. What happened there was they actually knew, the target company that was being acquired or merged with, I can't remember merged or acquired, but, that was happening. The deal was being struck there. So they knew what the target price was and they knew how the prices would move. So they called up their, relatives or girlfriends or whoever, and they said, you know what, I'm seeing this, so why don't you start buying it, right? And suddenly, the government monitoring this, the ACCA, I think it was, monitoring this, saw suddenly a pocket of investment really bubbling up, and they have strong surveillance around this, right? So they saw a very strong buying that was happening in a particular area, locality, and they were like wondering, what's going on here? Let's investigate. It's just an alert, right? So they haven't really suspected anything. So they went off and they found, the 2 bankers to be guilty of actually front-running insider information and sending it back to the clients. sending it back for their own benefit and cheating the clients, right? As a result, because you've disclosed insider information. So you'll find a number of cases why some of the bankers have got bad names is because of leaking of insider information. And I'm not saying it's associated with one bank or multiple banks or several banks. No, we don't want to make that statement because all of the banks have got really great ethics statements. They really do a great job in making sure that the investment cycle is maintained. They really help their customers, clients. They've got great social responsibilities. So they do all of that, right? Yeah, London Whale incident, Rikin, that's a good example, right, of what happened there. And there are multiple examples like that. There was, collapse of Barings Bank. Then you had the Society General. I don't know if you've heard of Society General's 7 billion. That's all public news, so I can actually say that. What happened there was, one of the bankers was not supervised by his trader. Very simple thing, he was not supervised by his traders. Let me give you this example, right? What he did was he actually started booking, false trades and creating a book, because what he wanted to do was he wanted to create profit for himself by showing, that the value of portfolio has gone up and the banks have made a great amount of profit. So he built up his book in such a way that it would present to management a profit scenario. And he bypassed a lot of controls and he influenced people to actually suppress, a lot of data for him to be able to do this. Again, we won't go into the details of how it happens, but you get the gist of it, right? So what essentially he's trying to do is suppress information, use his influence as a trader, and his supervisor is sitting, say he was in, let's assume he was in France and his supervisor sitting in the US. So his supervisor is not even having that sense check, sitting in front of him and saying, hey, something seems hanky-panky here and something's not right. So that benefit was also lost. So this guy was doing things on his own, and he built up a book that was so huge, and he got a huge amount of bonus. At least that's what we read in some of the articles, because of building up his book. And people were like, wow, fantastic trader. Only then, when the management started to investigate these high profits and where they're coming from, they realized these are all false and fictitious trades that were being booked, and manipulation of a lot of underlying data was happening. So this is really the dark side, and this is very much in the public domain. You can go off and read this, and you will find a lot of details, devil in the details in this case, I can say, isn't it? That is there, for you to understand. But again, highlighting an example to you where people can misuse their position. They have so much of information, wealth of information. So this is all considered private side information that you'll be holding, which your clients have given to you, which your stakeholders have given to you. Please don't misuse it, because information is precious, is absolutely precious, right? Because on information, when you have a tip, when you have an information, you can trade. And that trading is unfair because others in the market don't have the same information. If everybody in the market has the information at the same time, then that's a level playing field, and then each one's own judgment and investment can go in. So this is one of the dark sides of what happens with investment banking. So ethics and conduct are a very important part these days of an investment banking activity. We kept speaking about debt, equity, valuation, ratios, all of these good things we can all understand. But if you're unethical, you don't have the right value system, you front run your information, you strike deals by the side, then all this is going to fold up into a large loss for the banks. Has this happened in the past with the banks? Several banks have gone down because of unethical behavior of their investment bankers. Several valuations have gone wrong because of unethical behavior. So it's a very important side that I definitely wanted to share, with all of you. I don't know how I'm doing on time. I think we've sort of hit the 1 hour mark. So I just want to bring this to some sort of a conclusion, and then open up for questions. I can't see any WhatsApp at the moment, so I'm just trying to look at the organizers and see if they have any comments for me. No, nothing for me. So I mean, yeah. Hope you guys are with me at this point of time and you understood, the flow, and I'm going to do a recap. Excellent. I mean, I'm seeing a lot of yeses, so I really like it. Okay, great. See, we can only do as much, right? Because it's a 1 hour session, and and the investment banking industry has been here for 150 years. So there are multiple war stories that we can talk about, and we can take questions, at some stage. But let me summarize all of this, right, so that you can form a picture in your mind of what is the life of an investment banker, right? And what type of work do they do? So like I've been describing the work they do, right? So let me just summarize that and recap all of that in one capsule for all of you. See, thank you, Renuka. See, let me kind of put it like this, right? See, what we started with was a really intelligent person trying to, is there a myth or fact? Let me take this question. I really like it. Myth or fact that there is no work-life balance for an investment banker? Yes, absolutely. It's a fact. The life is really difficult. Like I will tell you, when I was working through and I still continue to work, life is not easy. You will have to spend the hours, but I'm not making you scared or anything like that. But sometimes, it depends on the individual. If you are clever, smart, and can get your work done and be efficient, yes, your life will be easier. But, walking into an investment bank, let me tell you, life is not easy. You've got to spend your hours. You've got to spend the time required, and maybe sometimes good number of weekends, good number of 12 hours a day, good number of overnights, at least I've done in my life, staying up to 5 a.m. So I can tell you all of that from my experience. But look, you guys are much smarter than what I was back then. So I'm sure you're going to be able to do that, very clearly. So there's a lot of questions on what's an investment banker, merchant banker, and all of that. See, like these are different types of activity. When you do merchant banking activity, you're called a merchant banker. If you do an investment side of what is merchant banking? Merchant banking is, the classic in the old terms, where you're working with the merchants, you're kind of creating a commercial activity, and all of those activities associated with merchandise and all of the other aspects you're going to be. How is IB different from boutique? Okay, I'm getting very, very good question. So let me just wrap up with my closing statement. Otherwise, people will not feel the sense of conclusion on this, right? So what is, coming back to the topic, right? What is the life of an investment banker? The life of an investment banker is exciting. Why is it exciting? Because I'm looking at opportunities. I'm not going to sit down and put my money in a fixed deposit. I'm actively thinking about opportunities. What is the life of an investment banker? A big portion is risk management. As I just mentioned, risk management is fundamental. Today, if I give you $1 million, you can say, okay, I will go and gambling machine. Have you thought about the risk? No. You've just said, if you had evaluated and said my risk appetite is only 20%, losing 20% of my value, then I would never invest in a gambling machine. So risk management is an important part. Objective of why I'm doing what I'm doing, very important. Ability to create synergies. This is a very important qualitative aspect that goes a long way in making a very successful acquisition and merger. You can't merge apples and pineapples. You've got to find a similar apple, a Washington apple with a Shimla apple is for possible merger, but you can't still have something that is diametrically opposite that will never merge. Reliance Jio and Facebook is a good example. I don't know how their relationships last, but sounds like, one is a platform, others providing an internet connectivity to that platform. Seems on the surface a sensible one to do. So something like that, right? And they've been very successful mergers as well. So that sort of synergy creation is important. Keeping in mind regulations. FDI investment in India stopped for Chinese. So today, if you were thinking of bringing a Chinese investment banker was thinking of helping a Chinese company acquire a 51% stake in an Indian company, not happening. He should be aware that India does not allow Chinese companies to take over Indian companies, right? A great move by the government. It will protect our industries, which really means an investment banker needs to be aware. So awareness is extremely important. Last but not the least is conduct and ethics, right? That is paramount. That should be inherent in you, and don't lose those qualities. Even if you make a little bit of less money is fine, but if you're ethical and transparent with your clients, it's going to go a long, long way in establishing a relationship, and more business will come your way, right? So this is what I would say is, in short, in an hour's time of investment banking, in a nutshell, right? Ethics are very important, Rikin. Yeah, you made a really good point. Now, what I can do is, if you could just, ping in some questions. I mean, there are loads all. I'm really sorry, but we'll take. How inside which I will worth or not good amount of risk is involved. Yes, Anant, a good amount of risk is involved. It's a lot of judgment and experience. A lot of senior people get involved with 30, 40 years in the industry. A lot of consultation happens, so it's not small. How big a role does data science play in this? Massive, massive, great question. And this is how you got to be thinking analytical. These days, you can't be sitting with calculators. You can't be sitting with Excel spreadsheets. You got to be talking about data analytics and data science. That's the future. To become a banker, what is the course that is helpful? So first is, you see, so there are two things to this, right? Okay, if you can just drop your questions, I will try and just for a moment, I'll try and answer this question from a career standpoint, right? Okay, I'll take this as a career section for next 5 minutes so that it helps a lot of questions. See, first of all, if you want to be a banker, right? How is IB different from boutique? I'll answer that, Vasudha. Let's do the career bit of it right now, right? I mean, because hundreds of questions on career. So let me focus on that, right? Skills required, Akshat. Yeah, I'm covering that right now. So what really happens is from a career standpoint, let me tell you this. One of the things that you got to be aware of is a lot of reading. I mean, forget what you are studying at the moment, right? Minimum, get an accounting degree for yourself, like a CPA. Call up Shripal and tell him, I'm just doing my CPA and need to finish it. Help me out finishing this, right? So first do that. Second, credit underwriting. I'm going to cover all of that. Second, pick up another international certification that is very close to investment and investment management. Whether it's an FRM, whether it's a CFA or whatever. Please pick that up if you want. Third, if you want to really build up your communication and client presentation, or if you think you're already awesome at it, then don't worry. Otherwise, pick up an MBA and cover that off. It's not necessary. It's not important. You'll find a lot of bankers are not MBAs. A lot of successful bankers are not MBAs, but have very strong accounting or understanding of accounting and other credentials. Because at the end of the day, the balance sheet is the fundamental, and your understanding of that is super duper important. See, you've got to have extremely engineering and IB after an MBA. Absolutely, please do that. No problem. You can do an MBA. I don't want to say. When I say I want to become an investment banker, I get a contact question as to what you want to be. Yes, look, communication skills is super important. In what field you want to be an investment banker? This is exactly what I was going to clarify now. See, investment banking just doesn't mean merger and acquisition. We spoke about it, right? It could just be doing credit. What does that mean? It means I'm going to take up certain loans and I'm going to take a risk on my books for those loans. So that is something I could do. I could simply do simple trading. I could do repo financing. I could do custodian functions. I could do, say brokerage, broker dealer business. I could do clearing business. I could just be a clearing agent. So just please do not think of yourselves as tomorrow tied up in a suit and boot and a tie and standing in front of Mukesh Ambani and trying to deliver him a presentation of how structure of his company should be. It takes a lot of experience, guys. So I would say don't get into this myth of investment banking means tomorrow I'm going to be sitting on a very large deal. It doesn't happen that way. Most of the large deals are struck by the most experienced people in the team. You hardly find people without experience, right? And they may be still young, but they will have had 10 to 12 years minimum in the industry to be sitting on a large deal, minimum, right? So start somewhere in the investment banking is my advice to you. Pick up any aspect, right? Pick up credit, it's okay. Pick up something in trade settlement, it's okay. Pick up something in clearing, it's okay, right? But build on from there and say, okay, from clearing now I'm going to move into derivative settlement. From derivatives, I'm going to move into vanilla trading of derivatives and risk management of those. Then move a step further and say, okay, now I'm going to structure these trades. I'm going to document this. So these are kind of things you've got to move step by step. Rome was not built in a day. So you've got to keep that in mind, right? And one swallow will never make a summer. I mean, it's an English saying, but if you follow me that if you just a little bird, it doesn't mean that nature is all green, right? You've got to understand that you've got to bring in a lot more skill in you to be able to get it. I think someone rightly said communication, right? You may be an awesome, can credit people shift to iBanking? 200% credit is a great skill to shift to iBanking. Remember that, right? Credit is a fantastic skill to have. If you can master credit, you can get a very easy entry into investment banking, of course, subject to your performance, your conduct, everything else, right? There's a lot of caveat to that. But if you have pure credit skills, it's a very, very good way to get into iBanking. So I will tell you this from a career standpoint, don't sit and scratch your head and say, when is my next deal with Mukesh Ambani or Mark Zuckerberg or whoever, right? It doesn't work like that. Please think about what is the skill I can build on, right? Yeah, Madhur, you work in credit, fantastic. Build on credit, build on. Can you do institutional credit? Can you do corporate credit? Can you do, structuring of credit? Do you understand, when when portfolios in credit actually are suffering, can you identify early warning signals in advance? That will make you a fantastic banker. So it's not about just processing credit, right? So build step by step. So there are 3-4 stages you can go in credit, right? And if you're able to identify, that'll be great. What books should we read? See, Vasudha, this is a very good question, and that is why I say pick up a course. So it saves you the effort of searching for a book. There is no book written till date that will tell you step one to step last. This is what investment banking was. There is no book. I will tell you that. I've read so many books, but there is no book, right? The best book is pick up a course. Like first finish your CPA very comfortably. Get that back because your accounting becomes very strong. Then take up a course like FRM or CFA or whatever you guys are doing. That book has tremendously good content, tremendously good content. I'll tell you, good enough for you to make a start. Plus, some of you are already working in credit space, some of you are already working in banks. Leverage, mix that experience and multiply your ability to move to the next stage, next department, ask for a change, move on. I don't know how easy it is in your company, but try and do that, please. So that you can constantly educate yourself and move forward. I am strictly telling you this. Please do not wonder today and procrastinate and say, how will I become an investment banker? Stop that thought. Say, what is the path to becoming it, right? And am I in the right direction? That is the question you've got to be asking yourself. And the direction is very simple. Get your education, get your investment banking experience and move on. Okay, I'm working in investment banking. I'm struggling with work-life balance. Please, there has to be some pain, otherwise no gain. I can totally understand for some of the people, you could have household responsibilities, you could have, marriage coming your way, you could have, but look, I mean, I'll tell you this, if you go back and read a lot of blogs on how to become successful, you've got to invest the time. I'm really sorry to say this, but I'm not one of those who really encourage people to give your life and blood, just for the sake of becoming something. But honestly, think about Roger Federer, right? He has to travel, all around the world to play tennis, in all circuits, has to give a lot of amount of energy, but still has to find time to spend with his family and for himself. Very, very difficult, right? I remember Serena Williams and Venus Williams used to practice 12 hours a day. Now, it doesn't mean 12 hours on the court and standing and hitting tennis balls, but it really means that in and around that, it will be there, right? So that's a kind of effort. But I'm really sorry to hear that you're working long hours. But my empathy with you. But try and see if you can get efficient and change that. I know it's very difficult. It's easier said than done. But this is going to be a challenge, right? Work-life balance is going to be a challenge, and it's really on you and up to you how you sort of manage it. The way I used to manage it is very simple. That I used to try and spread my work and do a little bit on the weekends as well. I used to get up at like 6 a.m. in the morning on the weekends, work till about 10 in the morning. I remember when I was in London, I did that, because then after 10, when it gets a little more bright in London, I used to go out, touring around or spending my weekend. So it at least gave me 4 hours of a good weekend in the morning where I wouldn't do anything. Of course, you guys will turn around and say, who gets up at 6 a.m. in a cold? But my incentive was to enjoy the rest of the day in the UK, which is so nice and beautiful during the day, right? So I would just completely do that. Same thing I would do in the in other parts of the world where I've worked, right? Is try and get up as early as possible, so that I work and then go out in the day. So that's how it used to work for me. But I don't know what your individual responsibilities are, so I can't say that. But find a way like that, some compromise somewhere, so that you're able to enjoy the rest of your life. And that's a good way of work-life balance. I still had to work 12 hours on an average, but I really liked it because I could go off on a weekend and spend my time in a beautiful country. So that is that's how I would I would put and answer that question. Sorry, can you ping me a couple of more questions, please? iBanking opportunity in India, fantastic time, for iBanking in India to CF. No, investment bankers will not recruit CFSs, sorry, they will not. You will need some evaluation experience. I'm a graduate MBA and also trying to get my FRM. Okay, let me clear FRM question. Yes, Ankit, I'll answer that question. You definitely need 2 years of work X to get your charter from FRM, but don't worry about the charter and all of. See, these are our mindset is very much like that. Mera degree, where is my degree? What do I do with my degree? Where is it missing? Kahan hai? Kya hai? Where is it? What is it? None of these we should worry about too much. Have you done the course? Have you cleared the exam? Fantastic. Get on the job. After 2 years, they give you a certificate. Fine. I mean, by hanging a certificate on a wall, it doesn't mean you're going to do a good job. You still have to apply your mind, do your brain, still apply the concepts you've learned. Right? Great question. CFA and FRM. I would say do both if you can. But if you're choosing between FRM and CFA, I'll tell you this: if you're working in the risk management field, core risk management field, please do FRM. If you're looking at an investment portfolio opportunity, please do your CFA. Both are fantastic courses. Either or any is okay. But if you know that you're going to do a lot of risk management, then please pick FRM. I'm doing my CA articleship in business valuation. What more should I do to enter investment banking? No, that's enough, Aniket. You can continue to do that. But look, I mean, nobody's going to hire you as a fresher. I mean, if you're lucky, they will. But try and see if you can, get in somewhere, but with a name that, you can get into a big four, for instance, right? And do some work on valuations. And then move on to investment bank into an, so you'll have to start somewhere and going. CA plus CFA fresher, which Vasudha asked me this question. See, freshers, okay, let me answer this question. Aniket is already in a big four, big five, whatever. Okay, so let me answer this question on this fresher thing, right? Look, I'll tell you one thing. You're very, very young in your career right now. Okay, so don't worry about it so much. Start somewhere. Like I said, if you're getting an opportunity in business valuations, like somebody said, fantastic opportunity, just do it. You may feel like, Arey, what am I doing? I'm heading nowhere. It's not you're heading nowhere, man. You're really heading somewhere. Only thing is, what's your next move is very important. You gotta pick up the next move absolutely correctly. You will say, okay, now I see an opportunity in, say, let's make it up, like say Deloitte. Okay, I've got no affinity towards any company, but I'm just saying example, just EY, whatever, KPMG, whatever it may be. Oh, they've got like an analyst requirement for business valuations. Just go in there. I know one of my, one of the persons that I mentor, she got in that way. She was just a graduate actually, and then she picked up her CPA and then she built on. But yes, the opportunity is what you've got to pick up. Look out for it, but start somewhere. Don't start with a mindset that, oh, I'm not in one of the largest investment banks in the world. What am I going to do? I don't think I'll ever become an investment banker. No, please, that's a very wrong approach. Please make sure you start somewhere relevant. Of course, if you're doing gardening and you want to get into investment banking, very difficult, sir. What you've got to be doing is something relevant, build on some technical courses, keep studying, keep up to date, keep reading, find an opportunity and jump in. And that opportunity may be very small. Like somebody was talking about credit, right? I really like that example, because you may see a small window and say, okay, credit valuations I'm doing. Just get in and see what it's doing. But make sure you're getting in worthwhile, right? You're not getting into a company that doesn't even know what they're doing and you're just struggling. So be careful with that. I'm just saying, get into that space. But then your mind has to be that I have to build knowledge. I should know, I need to be the best credit valuer in the world. Something like that. Are NSC courses in India helpful? Not very helpful, Aniket. Please do your FRM CFA, that's enough. Don't get into these small, tiny little bits. I mean, I'm not saying they're unhelpful or anything like that, but they're just more a extract of all of these large courses. So no point wasting your time. IBBI valuations, is it necessary for IBI? No, it's not necessary. So certifications are going to be prescribed by regulators, so you don't worry about it. Once you join, they will ask you to do. I'm CFA level 1, working in a bank is very good. Can I get? Yes, absolutely. You're doing the right thing. You can get in. You see, this is a great example. I just got one question before who said, I'm CFA, let's assume he completes his CFA, he's working in risk management. Can he become an investment? 100% you can. I mean, I'm not saying, I guarantee, but I'm saying this is the step, this is the path, right? That's how you start. Samish says, in the front office of an investor, front office needs a lot of acumen. You need to understand the market. So what would you do if I tell you you have to create a butterfly spread of using options. You should know that. How do you use that option strategy? You don't know. Option strategy, you don't know. So you got to read something about, got to gain some experience with it, and then you will be able to get into the front office. Front office hiring is very, very specific, guys. You have to be very, very careful. Get some experience. But I'm not saying you need to have finished a merger to get into a investment banking in front office. Not at all. If you're a great risk manager, if you're a great credit manager, if you're a great portfolio manager, in a small sense, like you're executing, just execution because you're freshers, you will be considered. Trust, you will be considered. Private equity industry in India is good at the moment, but it's a good industry. But a lot of risky because if a couple of investments go bad, you may not even get your salaries. So can you summarize your career till now and ups and downs in your way? Okay, see, from my career perspective, like I'll tell you like this, right? When I started off with an accounting degree, my chartered accountancy, and that's how I got into investment banking. I did a lot of trade settlement, and I did a lot of credit analysis, like for the front office in terms of the CSAs, right? So I actually had the opportunity to look at credit support annexures, and then I went on to my CPA because I thought US-based, because I was working for a US investment bank. Again, I won't name, but I was working for a US investment bank and a very, very large US investment bank, and I had the opportunity to work in the US and then in the UK. So I was seconded both, so I was able to work with the front of else, some opportunity there, and then came back to India to kind of do some of the related activities, and then set up a team in India, and then went to my FRM because to risk management space and actively looking at risk management space globally, and that is where I picked up my role. And then because of my expertise in risk management, I got hired with another bank now, where I head the as well as for Poland. So I'm kind of making that as something that I do at this point of time. But yeah, of course, I'm not naming any bank or anything like that because this is just a good informal session for us. But that's been my career journey, and looking at a lot of aspects. And just like you, I did not start really well, right? I just picked up a small accounting finance job, but I did that really, really well, right? I did that really, really well. And I got a lot of credit for doing that well. It has CPA degree helped you in your IB tremendously? Philbert. Hello.
Yeah, sir. Now I can hear you clearly.
Oh, fantastic. Okay. So I think there's with these meetings. Sorry about this. I don't know. Okay, excellent. Thanks, Aniket. Okay. So I guess we've sort of covered a lot of these career questions, and investment banker will only focus one deal at a time on multiple deals. Multiple deals, you can't focus on one deal. But if it's too large, then obviously you will get sucked into one. But it's going to be always multiple. You got to be on the lookout. You can't just be, it's almost like that. It's like hunting, right? What does a tiger do when it's hunting? It actually goes in the jungle and looks for every opportunity to eat. That even if a bird is flying, it will try and pounce on it and try and eat it. So it's like that. So whatever little opportunities, mindset has to be very optimistic. I mean, I don't mean in the negative sense, but more in the business sense, right? I see an opportunity, can I cash in? I see an opportunity, can I cash in? What can I make out of this deal? Can I make a little bit of money out of this deal? So this sort of mindset you've got to have. Yeah. So okay, I think we've spoken quite a bit about all of the career aspects and what different banking activities does. So I guess what I would give you like as a final sort of closing comment and a piece of advice, right? Is that please do not get too carried away by multiple things in your mind and get confused about what you want to do. Right? Focus on what you're studying. Be an expert at what you're studying, and I will tell you the expertise only comes in application. What you learn, you should apply. If you're unable to apply what you learn, it is pointless. I mean, you may study another 20 degrees, you will get nowhere, right? You will be only in the same theory, you will only be in the books and you will not be able to go any further. So bear in mind, whatever you're doing, be an expert at it and keep your goal and aim very clear that my next stage is to move here and find that mission goal, equip yourself and move forward. You have to try. Sometimes luck will play a role. We can't control that, so don't bother about that too much. Be happy with what you get, but at the same time, do not forget to set your goals. Set your goals and move ahead. And partner with Shripal. Yeah, he's a great guy. He will help you, coach you, guide you. A lot through this journey. So it'll be very helpful for you to kind of think about as you're doing your CPA and FRM and all of that stuff. So make sure that you're getting that career advice from him as well, and then sort of move forward. So I would just strongly encourage all of you to do that. Take the worry out of your brain. I think that's the first thing, and bring in the application side of your brain in, out of it. So the worry out and the application in, and you'll become fantastic people. I'm telling you this very, very clearly. And of course, you have to go through a little bit of pain in terms of your work-life balance. I totally empathize that with you, and I don't mean to be harsh on this, but the reality of life is sometimes you've got to give in the extra hours, but still try and manage it. Be clever about it and manage it, is what I would say. But yeah, there are no 9 to 5 jobs anymore in this world, so that's going to be very hard to come by, especially in these difficult times, right? So questions, I am able to answer all, but I try to summarize the key aspects. So if you want to pick it up from that, that would be great. But if you still would like to discuss different topics, do reach out to Shripal, and then he will connect with me. Maybe you want to do something on risk management. I'm more than happy to cover it for you, because there were a lot of questions on risk management. So fantastic, and I'm getting a lot of thank you messages. So I hope you really like the session. Please do send in your feedback. Very valuable. People are finding it. I'm really liking these comments. So please do let your feedback come in. Mohammed, thank you very much for that. We need one more session from you. Thank you. Ekta, thank you. Samesh, thank you. Bobby, thank you. Lena, thank you very much. Rudrik, it's flowing very fast. Sorry if I missed some names. Sanket, Rinkin, Renuka, thank you. Thanks, Atan. Thank you, Shriya. Thank you. Nitya, thank you very much. So I can go on, thanking you guys. Vasudha, good questions. Rinkin, great. Aniket, great questions. Thank you. A lot of good questions flowing as well. So I was very impressed with Akhil, great. Pratik, great. Mohammed, thank you. Akash, thank you. Yeah, no, I can see a lot of comments other than the thank you. So I really appreciate that. And look, if you want to learn something, please connect with Shripal and let me know. I'm more than happy to spend an hour or 2 hours with you guys. It's only my way of giving back to education, right? So I'll be more than glad to do that. And I love students, so that's going to be even more enriching for me to do it. All the best is what I would say in the end. And thank you to the hosts as well who are doing the yes on LinkedIn. Please send me a request. I'll definitely try and accept everybody. I may be a little slow, but I'll try and accept as I can. Yeah. Okay. Thank you for that compliment, Jigar. That I'm good at teaching too. Yes, I can take up teaching at some stage. I need willing students like you. So, that may be an alternative career option. Maybe I come and teach at Simandhar Education at some stage if Shripal thinks I'm, worthwhile as a teacher as well. So we can definitely do that. But yes, focus on your basics and apply your concepts. I think you'll do a really good job in your lives, right? Thank you very much, and thank you for all the the people working behind on the technology. You really did a great job in making sure that the session had minimal interruptions, right? Despite doing this on a third-party platform, right? Yeah, thank you for keeping that really good. Yeah, okay, well done on that. Yeah, okay.
Thanks a lot, sir.
We'll probably end here. Yeah, no problem.
Yeah, sir.
We can end here.
Yeah.
Yes.
Yeah, sure, sir.
Okay.
We can end.
So I will leave. Yeah, thank you, everyone. I'll leave the meeting. Sorry if I didn't answer all your questions, but I'll be leaving the meeting now. Thank you very much.
Okay, sir. Okay.
Please do send in your feedback. Yeah, all of you, please send in your feedback to Shripal, please. That'll be really good for me. Thank you.
Yes, sir. Thank you, everyone.